Hello everyone, and welcome to the DashCast, where we go about trying to find the most interesting people in the world of cryptocurrencies, finance, and business. On this episode of the podcast, I had a good amount of time to sit down with Austin Woodward, the founder of Taxbit. With tax season around the corner, I thought it'd be a great time to gain some perspective on the new tax laws, as well as understanding Austin's journey as an entrepreneur in the crypto space. So if you're looking for a success story or are curious as to how to conduct your taxes for 2018, stick around. You won't want to miss this one. Our sponsor for this episode is the Dash Report. For those of you out there that like what I do here on the channel in regards to covering a wide variety of markets, I feel that the newsletter would not only be for you, but it's a great way to support me if you like what I'm doing here on the channel. We not only cover cryptocurrencies, but a wide variety of other markets such as equities, commodities, and Forex markets. And I'll even post trading opportunities that I'm watching for the month as well as macro analysis on a variety of markets. So if you guys are interested, check the link down below for more information. What's going on, everyone? My name is Nicholas Merton here at DataDash, and today we have Austin Woodward, the CPA and CEO at Taxbit, one of the top leading platforms to file cryptocurrency taxes. And today we're going to be talking about all kinds of really interesting things, from filing cryptocurrency taxes all the way to understanding really the current status of crypto in the eyes of legal authorities such as the IRS. So, Austin, thanks for making the time, man. I know you're busy with what you guys are doing over at Taxbit.
It's a privilege to be here, Nicholas. I was actually introduced to cryptocurrency from your show in 2017, so honored to be here and big fan of your podcast.
Oh, I appreciate it, man. It's been a long journey so far for the channel and everything, and you know, starting off into the whole podcast and doing a few of the other things we're doing. But I'm very interested, Austin, to kind of get some perspective here, because last year we did a video on taxes. It was a good little intro video to kind of understanding some of the new tax laws that went past in 2018. But I'm very curious to just get someone like yourself who's in the business 24/7 of dealing with taxes in crypto, a general definition as to how the IRS views crypto, because we hear so much about the SEC, the CFTC, these regulatory agencies that deal with securities and commodities. What does, the IRS think on all of this? That's the key thing here when we're talking about taxes.
That's a great question. There is so much confusion. You hear about the SEC. Is it a security? Is it a utility? But not very many people know about the IRS's definition of cryptocurrency. Well, actually, in 2014, they made it very clear that cryptocurrency is property, and that kind of hasn't been disputable from the IRS's eyes. However, where the recent developments have occurred in 2018 is around the whole notion of, is it property that's eligible for like-kind exchange treatment? So like-kind exchange, that's kind of a tax nomenclature, but that just means, can you trade one asset for another asset and defer taxes on that? Prior to 2018, that was unclear. So many cryptocurrency people, if they were trading Bitcoin for Ethereum, they weren't claiming that as a taxable transaction. Well, as many of us know, in 2018, the largest tax reform of the last decade actually happened. And there was specific Irs guidance when it comes to cryptocurrency. And is that eligible for like-kind exchange treatment? And the answer is no. It's actually treated the same way as stocks. So similar to a stock, if you were to exchange Apple stock for Microsoft without ever converting to fiat, that's just not heard of. But that would be a taxable event. And the same is true for cryptocurrency. So anytime you trade one cryptocurrency for another, that's taxable. So that was clarified in 2018, along with some other things that the IRS has come out just saying how important it is for users to declare every transaction on their tax forms. And they've been very serious about that. And so that's helped clarify for the 2018 year going forward. So it's absolutely indisputable now of what we need to do, which is actually nice. I mean, not everyone's happy about that, but it's nice that we actually have guidance now to go off of.
Yeah, at least something to understand. So to kind of simplify that in a kind of bullet point, basically any transaction you are making between different digital assets, it doesn't mean just simply fiat transactions to crypto. Or vice versa. It's any kind of transaction in that case is a taxable event and is subject to having to be reported to the IRS. Okay. So, I mean,
Yep.
we have this similar nature, as you mentioned, if you were to exchange from a stock to a stock. I'm curious in this case as well, getting an understanding as to, what's the kind of range, for example. I know everyone should probably report to the IRS and everyone should report their taxes. But one thing that I get asked a lot is, people, for example, who have $200 in their crypto portfolio, or some people have much larger investment portfolios. I noticed a while back there was a quote from the IRS or some kind of article that came out that there was like, if it was 10,000 or above, that was really the mark where they started to get serious about it. What would you say that mark is in that case?
Yeah, that's a common question. I'm glad you asked. And it's even become more confusing because everyone heard of Coinbase and the IRS coming after them for not issuing 1099s. And then they did to users that have $20,000 and more in asset value. However, in 2018, it's become clear now that every transaction you need to report regardless of volume or market value in your portfolio. And it can get complex for sure. Tracking all those assets, tracking, if it were just crypto to fiat, like that's doable, but crypto to crypto adds a whole new complexity. And then if you ever purchase goods and services with crypto, there is now specific Irs guidance that we can include a link to actually that shows, hey, we're serious. Every transaction needs to be reported. And I don't want to scare people, but they put threats in that guidance as well, just because I've talked to a lot of regulatory authorities and they're actually supportive of crypto and blockchain. They love the innovation and they recognize the disruptive potential that it has. But we need to make sure that we're also funding our societal needs as well. And so avoiding taxes is a common question. What do I need to do around that? And we just need to, in order to progress crypto, that's our mission at Taxbit, make it easy for crypto to become mainstream by easily complying with government tax regulations in the US and internationally. And so we've made it easier to do that. We'll talk about that later in the show, but it doesn't need to be a burden anymore.
Yeah, it was interesting. You used the term like crypto transactions, and I think it's important as well that people understand the distinction of what we're discussing when we say transactions, because there's a lot of technical lingo and stuff when you're talking about the world of taxes and finance. But one point that's interesting, and you can tell me if I'm wrong, Austin, basically when we're talking about crypto transactions, we're not talking about moving crypto from one exchange to another or a wallet. Those aren't taxable events. It's just simply moving funds. But when we transfer it with something else, if we convert to fiat, if we convert to another digital asset, if it's not something you're holding for a year plus, something for the long term, if there's been a sell event, then in that case, that's a taxable event.
I'm really glad you asked that question. That's 100% correct. So one of the complexities is just tracking chain of ownership. And so like you said, if you move it to a wallet or another exchange that's in your possession, that's not taxable. However, many CPAs they're confused. They don't have much experience in this space. And so a lot of softwares even are counting those as taxable events. And we want to make sure you don't do that. The only thing that's taxable is when you convert back to fiat, or if you convert to a new crypto, or if you use crypto to purchase goods or services. So tracking that chain of ownership is very important. And you mentioned kind of holding period, long-term versus short-term. You want to make sure that, your software is picking up. When you transfer to a wallet, it detects that and it doesn't reset that holding period. Meaning you want to get long-term gains whenever possible. So making sure that transfer doesn't constitute a new reset of your asset acquisition date. That's very important.
Yeah, that plays into the same kind of tax ramifications of holding equities longer term rather than short term. So if not only does it depend in the United States, if you're trading a certain stock and you're, I know, for example, if you were younger, for example, if you were still going to school, you actually paid a lower capital gains tax. And then once you're an official trader or you go to certain trade brackets, you pay a higher one. And then the length of time you've traded it as well. So it gets kind of complex. I think sometimes there's too much complexity, but that's another topic in that case.
No, for sure.
Yeah. But nonetheless, you're very right. It's the same exact thing with cryptocurrencies. There are different laws that go into play whether or not you're trading in the short term or holding something long term for more than a year. In this case, we're kind of talking about the ideal situation, Austin, where a lot of us owe a lot of money, right? Meaning that we're up on our money, on our investments. But to be fair and kind of face reality, we've seen a really red year in 2018, and in 2019 we're filing for those taxes. So with most people probably in the red and facing losses, is there some relief that the IRS provides, or in more plain English, some deductions that we can look towards to in regards to when we're filing taxes and actually maybe turning it into a net benefit?
Absolutely. Yes. The IRS doesn't just require us to pay money, contrary to popular belief. They do provide relief during losses. So actually, it even goes beyond that. When we talk about the differences between stocks and cryptocurrency, you hear this term called wash sale at times. And that means if you sell an asset and repurchase it within 30 days in the security space, so for stocks, that is ignored. You can't do that. And you kind of maintain that initial cost basis. However, in cryptocurrency, because cryptocurrency is property and not a security, wash sale rules right now actually don't apply. So if you traded cryptocurrency at a loss, even if it's within 30 days of each other, you can write off those losses. And the IRS has rules that in a given tax year, all of those losses can offset dollar for dollar against any gains, whether it be amongst stocks, if you had a good year in the stock market. Well, if you didn't, if you're in a net loss position, even after writing off against all of your gains, you can claim up to a $3,000 deduction in that year, which will increase your tax refund. That's if you're married, and $1,500 if you're single. And then if you have excess losses that you didn't increase your tax refund with, you can carry those forward indefinitely into future years. So we all hope 2019 rebounds, and it's very important that we file the 2018 tax returns with losses. That way in 2019, we can offset those gains dollar for dollar. Yeah, that's huge. And that's something that not many CPAs even think about, is we need to track the carry forwards, not just the benefit this year, but how can it help us going forward?
There's a lifetime to it in a sense, with these transactions. And so to put that in simple terms, just to explain, guys, because I used to have this problem as well, and understanding like tax, deductions in this case, and taking previous losses, because I've had good investments and bad investments.
Totally.
The major thing to take into mind is that at a given year, as Austin mentioned, there is about $1,500 or $3,000, depending on your status in regards to marriage, that you can write off this year from your income, for example, or taxes that you might owe on other things, which is good. It's good in the short term, but if you have long-term crypto, like money that you have in crypto, and then you reinvest, and let's say next year you made 2 or 3x your original investment, if the losses you had in 2018 outweigh the gains you're about to have, then you'll be able to you won't have to pay taxes on that in that case.
That's 100% correct. Yeah. You can have tax-free gains next year by reporting your losses this year.
Yep. So that's where it carries over, instead of that $3,000 that you can use right now in regards to the year where you've recorded loss. Yep. So it's actually it's pretty nice in that case. If you're still kind of in the crypto game for the long term, you can still look towards that. And it is it's something that, like you mentioned, Austin, if we don't take advantage of, if we don't take the time to go back on that, it actually can be a really big net negative in the long term. Yes,
exactly. This year is very important. This is the ideal year to file a cryptocurrency tax form for 2 reasons. One, the IRS now issued guidance, so it's clear. And so just having peace of mind that you don't have any IRS risks. They've made serious threats. And then 2, to claim your refund, to increase that refund this year, and then carry forward those excess losses into the coming years.
Yeah. And just kind of getting a gauge here, Austin, just kind of talking more of your business side with Taxbit. Are a lot of people registering their taxes? I know that's something people usually want to jump with the trend, or they say, I'm not going to do it if anyone else is doing it. I know I filed my taxes last year. I'm going to be filing mine this year. Are a lot of people actually reporting on their taxes this year? Because I think that was a big reported issue last year in 2018 for 2017's taxes.
Yeah, that's a really good question. That's a common one that we get all the time. The blockchain's unreadable. Can the IRS ever trace me? Do I really need to do this?
It's private, right?
Yeah, exactly. It's private. Well, the answer is yes, you need to do it. And this year, a lot more people have done it because of the loss year and the clarified guidance. And the reason you need to do it is because, like I said, on one side of the spectrum, we've got our traditional currency system over here. It's very conservative. We've got a bunch of intermediaries, banks. It's centralized. We've got the government controlling it. And then on the other side, we have cryptocurrency. And I love cryptocurrency, but it's completely loose, right? And so the IRS and government authorities, they want to meet somewhere in the middle. Hey, guys, we don't want to disrupt your innovation. We don't want to ban cryptocurrency. We like what's coming out of it and the cool projects and all the disruptive potential it has. We just want some sort of way to make sure people are paying taxes and not money laundering. Yeah. And that's kind of the compromise here. And so yes, this year, the IRS has announced they've hired top blockchain authorities, like being able to read the blockchain. Chain analyst is one of those. And so they are investing resources into making sure that they can track people, as well as going straight to the exchanges. So you heard about Coinbase, but they're requiring 1099 reporting now. Not just on UX exchanges, but they're starting to talk to international exchanges as well. And so the IRS will have record of cryptocurrency traders. And so it's just best to, meet in that middle line, be compliant with the taxes, and be able to progress crypto mainstream.
Yeah, it's a big misconception. I think so many people get into crypto, especially if you haven't put a ton of time and research into understand the technology, that this is on an immutable public ledger, and that with companies like Chainalysis, the moment you buy something through a KYC verified exchange, which is pretty much the standard nowadays, if you go through Coinbase, Bitstamp, Kraken, Binance, whatever it is, you have applied KYC, and that identity is tied with the transaction history that's happening on that exchange. So
that's exactly right.
Yeah, it's best to just be transparent in that case, and to not get in. Trust me, it's much more of a burden. I've heard horror stories if you actually don't go through the process of actually filing for taxes.
Yeah.
In this case.
Yeah,
So,
and in my opinion, as we have those two ends of the spectrum, if we don't meet somewhere in the middle, the IRS is going to do one of two things. One, they're going to make examples of people, and they've threatened that with 2 to 5 years of criminal prosecution. I do not want to see that. Or two, which is just as bad, they're just going to say, ban, cryptocurrency can't be traded in the U.S. And so it's just important that we avoid those two scenarios. And what a better year to do it than 2018, where most of us lost money and we can receive benefits from doing so.
Yeah. So, I mean, as this space evolves, Austin, I think last year's tax law did definitely focus in a little bit on kind of redefining at least some of this whole new market of digital currencies. I don't know if we're expecting any major changes in the tax laws coming soon. I know there was talks about a second additional change to the tax laws potentially coming up. Do you think that there is going to be any more changes to the cryptocurrency laws related to taxes more specifically? And if so, do you think it's going to be positive or negative?
That's a great question. So I'm a CPA. I've followed, tax regulations for the last decade, and taxes, the law around the IRS code rarely changes. What happened in this huge tax reform, that was monumental, and that took a lot of legislature to get approved. And so me personally, this is opinion, I don't believe that we're going to see an overhaul for a long time. What I do see, though, happening in the crypto space is we've heard a lot of talk about stable coins being introduced in 2019, and a lot of institutions introducing those and putting significant money behind stable coins. Well, that will be really cool because stable coins are going to be pegged to the dollar. And by definition, if it's pegged to the dollar, you can't have a taxable transaction that ever varies from the dollar. So you can go and purchase goods and services with those stable coins. Companies and corporations will be able to issue dividends using those stable coins. And those purchases and those trades amongst stable coins won't be taxable. But when you trade outside of those stable coins in order to have appreciation potential, those will be the taxable events. So I do think we're going to see innovation around means where we can purchase things using cryptocurrency that will be pegged to the US dollar, and so that there will be less taxable events on that front. But anytime we're appreciating or depreciating capital assets, that's when those need to be reported and the taxes come into play.
So basically, you kind of see a vision where stable coins could play this role where, let's say I'm maybe staking, for example, in NEO at the moment, or in whatever cryptocurrency we can think of, Litecoin. And basically, I want to go do maybe a merchant transaction in this case. I could convert to the stable coin. I could convert my Litecoin to the stable coin and then obviously transfer the stable coin instead. So merchants are more happy along with that as well. In that case, is there only one outside of maybe sales tax, for example, is there really only one taxable event in that transaction? Or is it two if I'm just switching simply to Litecoin from Litecoin to a stable coin?
So if you converted Litecoin to a stable coin, that event would be taxable because you used a appreciable asset in order to go to a stable coin. But after that event, if you used a stable coin to do something else, that will be a taxable transaction technically because a stable coin's property, but there will be no tax impact because your cost basis is going to be $1 and your disposal value will be $1 for dollar because that stable coin doesn't move in value. So there will be one transaction that's taxable, but two transactions that you need to report. Just one has an impact. Yeah.
In this case, it would be similar to me taking out a stock and actually going to spend it on something. So it would be the same kind of tax occurrence. That's interesting. So, overall, I'm curious, Austin, because I've looked through the UI and everything. You guys have obviously been a sponsor of the channel in the past and stuff, and I'm proud to have you guys on because I love the user experience on the website for Taxbit in regards to just how simple and streamlined it is. I had originally used I can't remember. I think it was one of the mainstream online ones where you could apply huge spreadsheets, but it was still very complex. What have you guys done? What are some of the really cool features that Taxbit offers that you'd think everyone should know about, or maybe the top 3 that really make Taxbit stand out?
Yes. So Taxbit, it was founded by, this is what makes us unique. It's a trio of CPAs, tax attorneys, and software developers. So when it comes to taxes, software developers are so important in any software business, but who you really want to handle your taxes are CPAs and tax attorneys. So we were founded with that premise that we're going to be the best in all three of those areas. And we've dedicated a significant amount of time and resources over the last 14 months, and we're making great progress. So our software will API with your exchanges and with your wallets. We're continuously adding more API integrations every day. You'll be able to automatically pull in all of your transactions. We'll run them through our tax engine that's been vetted over and over again by CPAs and tax attorneys. And then it will automatically calculate those gains and losses. And what's cool about it is we want to have visibility as we go throughout the year. What do we owe? Do we need to plan ahead? Like in a year like 2017, where people were making massive gains and not even converting back to fiat, what do we owe? How do we need to plan? The last thing we want to have happen is come April, we owe tons of money that we didn't know about. Yeah. So our software is designed to be used throughout the year. And we're embedding features like tax optimization scenarios. Hey, if I come in the future, it's our hope that goods and services are being widely accepted with the purchase or payment of cryptocurrency. So if I want to go buy a car with cryptocurrency, what coin should I use? And our software will be able to tell you that in the near future. You're going to save taxes by using this asset as opposed to this one. And so we're constantly improving our tool to obviously handle your tax forms, generate you your 2018 tax refund, but then be usable throughout the year to provide you with the best tax advice by the best tax experts in the industry. So it's really exciting.
Yeah. So an example that you could bring up for what you were talking about earlier, like advisable situations, you could have maybe two cryptocurrencies you're holding, one that's gone up 5% and one that's maybe gone up 20%. If they hold the same market valuation of what you need to use to purchase something, it would probably be best to use the one that's gone up 5%, correct? Because the 20% can be seen more as a long-term investment in that case.
And then there's one other variable in there, and that's the holding period. If you have an asset that you've held for over a year versus one that you just got, then you have to take that into consideration and run the algorithms on that. So it gets complex. Everything we've talked about on this show actually is complex. And that's how Taxbit started. I was doing my own taxes for 2017. And before I knew it, my spreadsheets, I'm a CPA, and it took me days, macros everywhere, just all the exchanges just spit out your data in these unreadable formats. So getting it all formatted correctly, I realized, wow, software has to solve this problem. And it now does. And it's exciting. You can have your taxes done as low as $50 a year is what our plans start at. And it can be done instantaneously by yourself without even the need for a CPA to do it. And so that's exciting. And that's going to really progress our industry as we help crypto become more mainstream.
Yeah, it seems like you guys are honestly kind of hitting the nail on the head on becoming the TurboTax of cryptocurrencies, which I'm very excited about. And I think, again, with the experience I had in 2017, where, again, I still had to go through that, what was actually might be seen as streamlined at the time, with the exchanges finally started to provide I think it's CSV files or basically spreadsheet files. Yeah, and I was basically just having to import every single one without having a direct way to connect to my exchanges or some streamlined way where I could just easily integrate things all in one.
And you don't want to have to keep importing every new transaction. You just want to be able to log in one. The new ones come in automatically, and that's what Taxbit does.
So in regards to talking about this integration where every transaction will come back into Taxbit in this case, how many exchanges are you guys paired with, and like what are some of the big ones that people might know about?
Yeah, that's a great question. We're adding new exchange integrations each and every week. So right now we're with Coinbase Pro, Binance, Bittrex, some of the big ones, Uphold. And we're continuously adding more. So by the end of this month, we're going to have all of the largest ones you can name. So Kraken, Gemini, Poloniex, anyone that you can name that we've used, aside from some of the small ones. For the small ones that people aren't using that much, we do have CSV import functionality. So you can still get your transactions in, get your taxes taken care of. But our goal is to make it as streamlined as possible. So those integrations are continuously a priority of ours.
Interesting. So I'm interested to dive down this rabbit hole here in Austin in regards to, we've kind of talked about trading and investing, for example, but there are different ways that people make money in crypto. In regards to like mining operations, what are the taxes and ramifications around people who are doing mining? It's not as frequent, obviously, but it is something that I know some people have done. They've started to mine crypto on their personal computers that they at least can turn a profit on.
We get that question quite a bit, actually. A lot of miners are, what do I do when it comes to taxes? So mining and staking, the tax code, so I'll speak this in English as opposed to tax code speak, it requires you to report the income of the fair market value of the coin you received in return for mining or staking. You're performing a service in order to generate revenue in that case to you personally. So the fair market value at that time that coin was delivered to you, that's ordinary income. So that needs to be reported along with any other income that you made through a W-2 employer. However, after that, that's where the tracking becomes complex. What happens if you dispose of that asset or if it appreciates? That's where Taxbit will come in and capture any of those subsequent movements or trades of that coin that you received in exchange for mining. In addition, all of those mining trades, we're able to asset tag those as income transactions or mining transactions. So you can easily filter on those transactions and report what the fair market value of those were at the time you received them. So that's a great question. Miners and stakers, you kind of have two taxable events to report as opposed to the one. It's not solely a capital gain or loss, but you do have an ordinary income play that comes upon receipt.
So I'm curious about this. In this case, Austin, there's always the good scenario where it could appreciate. But let's say, for example, that like you were a long-term supporter of a proof of stake network and you had 10,000 coins staking. And with that, you get a 1% interest each year. So you make 100 coins. But so in that case, you've made a profit of 100 coins at whatever market value they are. But let's say the market value of that coin drops 50% and you're still staking it. Do you still have to report, the tax? Do you still have to pay taxes on making 100 coins in that case at whatever market value it is at? Do you get what I'm saying? I know it's.
I absolutely get what you're saying. Yes. At the time that coin hits your wallet or wherever it's being delivered to, that's income, unfortunately. So then if it drops in value, you'll be able to use those losses as we talked about earlier in this show. So in the long run, it will still come back and all equal out at the end of the day. But in the short term, yes, you might have a tax obligation that you don't have a wherewithal to pay because you did held onto those coins and then you had to increase your income that you then owe taxes on. So miners and stakers, be aware of that. If you are worried about being able to front a tax bill that you don't have fiat value to cover, it's best to go ahead and dispose of those coins pretty shortly after you receive them. That way you have that wherewithal or that means to pay that tax liability. If you're a believer in that coin, then go ahead and take the risk or gamble. If it does depreciate in value, like we said, there's still loss write-off potential in the future. It just could create some headache for you in that short term.
Right. So something you could still look towards in the long term in that case. Okay. Well, cool. Awesome. This has been good. We've covered a lot of ground. We talked about, not only mining and kind of some of the niche fields, but also just the broad market of trading and investing. And also what you guys have been able to do and just kind of compiling and simplifying things for the experience. How do people kind of go about starting this process? Because I understand, I think a lot of people just hear taxes and they just kind of get thrown back and don't want to deal with it. I mean, is it, how is it to get started on Taxbit?
Yeah, that's a great question. So we have a partnership with DataDash. Actually, DataDash users get a 10% off discount. We have a direct URL link that Nicholas will include at the bottom of this video. You can use that link and that discount will be automatically applied. And then the process is very intuitive. We've made it simple. You'll go on, you'll register for an account, you'll pay, and then it will guide you through the whole API linking process. It will pull in your transactions, and then from there, it's self-explanatory step by step. You can also use the promo code DataDash if you just go to taxbit.com. So a very simple sign up. And you'll just have peace of mind. For one, you're going to get a tax refund this year or increase your tax refund if you had losses in 2018. And for two, you're going to just know that you're safe when it comes to the IRS. They're looking into this. And three, everything we just talked about, although it's complex on the back end, we've made it easy. So trust our tax experts. We've got you taken care of. And you won't have to deal with all the complex math on the back end. You'll just be able to see this beautiful user interface and have your tax forms generated at a click of a button. So very slick. And we really are excited about this partnership with DataDash.
Hey, man, it's a pleasure to be partnered with you guys because, again, I've been trying to search for that experience for a while. And with the hassles I had last year, I can only assume what it was like for some people who did more active trading than I did.
Yeah. And we've got some going in, tens of thousands of transactions. Like imagine paying a CPA to do that. It's going to cost thousands of dollars. And so it's really exciting.
Yeah. And one thing I wanted to, talk about, Austin, because we talked a lot about Taxbit here, but I'm curious as well, having you on and everything. You said you basically, not only you had found the channel back in 2017, I really appreciate that. And you've also talked about how you went through your own hassles trying to report in 2017. How have you grown this business up so quickly? I'm very curious to ask you about that, because it seems like you've done a really good job. You've been able to streamline things very quickly, get the proper CPAs, attorneys, and also get the developers as well. I mean, Taxbit has really been built up quite quickly.
Yeah, that's a great question. We knew we had to move fast because the 2018 tax reform was announced in beginning of 2018. So we moved quickly. I've been in the software and finance industry my whole career. So I've worked at rapidly growing tech companies, taken them through S1 IPO processes and major acquisitions. So, I mean, we have the right background on the team to be able to rapidly scale a startup, but we're also very well backed. We're VC funded by top investors, and we're going to be around for years to come. This is just the beginning. This year, we want to be able to make it easy to file your taxes. But in years to come, we want to be able to handle international countries. There's a lot of your audience that are from international jurisdictions. Right. We're going to be adding those tax codes throughout this next year in hopes, in addition to just so many other things that users don't think about. Tax optimization strategies, being able to open up a mobile app and say, hey, should I trade this coin or this coin? What's the tax impact of that? We're integrating with exchanges through their APIs and being able to embed our calculations into their services. There's so many things going on, and it's going to be very exciting to see the progress of Taxbit. But just know you're in good hands, and we're going to continue to satisfy users and release new features that no one else is doing.
Austin, in a world where taxes get more and more complicated, you guys are making it simple. Appreciate it, man. Yep. Thanks for coming on.
Absolutely. It's a pleasure to be here, Nicholas. I'm a big fan of your show.
Thanks, man. Much appreciated. And that's going to be it for this episode of the DashCast. Thanks so much, everyone, for tuning into this episode. If you liked it, please give it a thumb up or a positive review, as well as giving a comment down below as to who you'd like to see on the next episode. I always appreciate your guys' feedback. I also want to give a real quick shout out to Austin for coming on to the DashCast. It was not only great to see Taxbit progressing over the past few months, but also to get a little bit of perspective from Austin in regards to taxes, as well as his personal journey. It's great to know that he's been a fan of the channel for quite some time, and I'm glad to see he's continuing to succeed. Once again, our sponsor for this episode is the Dash Report. Look, guys, I know that there's two types of people who watch my channel, those who think I ramble too much or those who can't get enough of the rambling. And if you fit into the latter of those two, I think the report would be really good for you. As I mentioned, we not only cover a wide range of markets covering macro analysis as well as trading opportunities, but in fact, I'm going to actually leave a copy down below for you guys to check out in the description if you guys would like to see what you can expect. It's the January edition from this year, so you can see what I cover as well as what you're going to be getting inside the newsletter. So again, if you're interested, feel free to check the links down below.